Real estate investing is hard, and even in a rapidly growing market like Dubai, wrong decisions can lead to failures. But I have a solution that can dramatically increase your chances of generating high returns on your investment. I'm a former banker, so I combine my financial expertise with my team's decades of real estate experience to develop the step-by-step blueprint for Dubai property investing, which starts with step 1: setting your goals. I have some bad news for you. The perfect property doesn't exist. No matter how hard you try, you won't find something that ticks every box. So your first step is to decide what you're hoping to achieve by investing and what level of risk is acceptable. Here are 3 investment goals you may set. The first is generating cash flow. You might be hoping for secure, stable returns on investment you can hold for years. That means investing in reliable rental properties that generate income no matter what. Or you might be focused on generating as much cash as possible. This can offer higher returns, but also comes with a higher risk. I don't mean you could lose everything. Real estate isn't BuzzFeed stock. The risk is about the stability of cash flows. The second potential goal is long-term resale. This goal is perfect for investors who want to secure the highest possible returns over a long period of time, but who are also okay with a moderate cash income stream along the way. This type of investment should expect a planning horizon of 5 to 10 years, or possibly even longer. So it's for those who have other income streams alongside ownership of the property. The third and riskiest goal is quick flipping. This is for get-in-get-out investors who want to leave the investment in a short period of time. This is the highest level risk investment in the market. So please don't fall for promises of get-rich-quick gurus, and don't even try if you don't know what you are doing. And as soon as you've decided what you want to achieve with your investment, it's time for step 2. Defining the target property. This is where many investors fail, because what you need for specific goals and what you like are often completely different things. I'll explain everything in a moment, but if you'd like to have this discussion tailored to your personal investment goals, just drop us a message on WhatsApp. So let's start with generating cash flow. Your high-risk and often high-reward option is short-term rentals. There are 3 target groups you'd be looking at. First are tourists. They naturally prefer landmarks such as downtown or near the beach, the Palm, Marina, GBR or Blue Waters. Second, business travelers. This group comes to Dubai on business trips and prefer to stay near the office hubs, meaning you'd be looking at places like Business Bay or the AFC. The third is expats. This group switches between different properties and different areas as a way of finding a better place to live. Short-term rentals are riskier because booking periods are short, meaning you need to constantly promote the property to get tenants. In a best-case scenario, a property would achieve a 95% occupancy or more, but the norm is around 75 to 80%. They also require initial costs to renovate and furnish the place. And as the owner, it's your job to cover all the utility and cleaning bills. However, if it's executed successfully, they bring higher returns than other options. We're talking about 25 to 35% higher than long-term rentals. The low-risk option is, of course, long-term rentals. While the returns are usually lower, it's far more stable investment. You should look at areas with high rent-to-price ratio. You figure this out by dividing the annual rental income by the property price. And this should give you an indicator of which areas have the best rental yields. Now let's discuss which types of properties you should look for when it comes to surviving market crisis. We'll take a historical example. Over here are the average apartment rental prices during the COVID period. During that time, rents for new apartment leases dropped by about 27%. Now compare that to the numbers on the right. They represent a different property type. These saw only a 13% drop. What kind of properties held up better? Villas and townhouses. And it's not just them. Bigger apartments show similar dynamics. In Business Bay, 1-bed units fell by 25%, while 3-beds dropped just 16%. In downtown, 1-bedrooms declined by 20%, compared to only 8% for 3-beds. Dubai Marina shows the biggest gap. Rents for 1-bedroom units decreased by 31%, while 3-bedroom rates slipped just 4%. Why the difference? Larger apartments tend to attract long-term residents, especially families. These tenants are typically more stable. they stay longer and make more considered decisions when renting. Meanwhile, neighborhoods that rely on short-term visitors and tourists tend to struggle during any economic shock, not just pandemic. So if you're thinking long-term, focus on family-friendly areas and larger units. They are more likely to offer consistent, reliable rental income, especially during uncertain times. Speaking of long-term investments, let's move on to the goal of holding for several years and reselling. I bet you know that the best tactic is to lock in a property that is high in demand but is limited in supply. The question is where to look for the undersupplied properties. Here's an example. Beachfront real estate. Let's take a look at the bigger picture. These 35,000 units along the coastline here make up only a tiny slice of roughly 800,000 ready units currently available for investors in Dubai. This means that beachfront properties make up just 4% of the entire market. And if you do the same calculations for all the developments under construction, the percentage doesn't shift much. Depending on whether you include Maritime City or not, waterfront properties are only 2 to 3% of the total. This scarcity has made a real impact on performance. In recent years, coastal areas have seen property values climb far faster than any broader market. But waterfront properties are not created equal in terms of risks and potential returns. If you're aiming for the highest profit, your best bet is an early-stage project in an early-stage area. However, because they're early-stage, they're a lot riskier. If you're looking for a long-term resale and would rather avoid the risk, look for high-quality developers in developed by one-of-a-kind areas. For example, the Palm Jumeirah, where even below-average projects can grow. Take a look at these graphs. These developer projects are far from the best in terms of value appreciation. These are their normal results. But they have a building on Palm Jumeirah. It's a standard building for this developer in terms of quality. But since 2020, prices on that building have gone up 25%. Best areas boost the price of even low-quality properties. But for those who don't want to wait for 5 or 10 years, let's talk about what you'd be looking for if your goal is quick flipping. And no matter how good you are at revealing high-potential opportunities, it's impossible to make a low-risk quick flipping investment, because many things can go wrong with it. Let me explain. You normally can't sell right after the down payment. There are still a number of steps to go through. You still need to sign a sales and purchase agreement, which can take a couple of months to be prepared, and only then you'll receive your akut, which proves that you actually own the property. Congrats! Now you officially own the property, but still can't sell. The limitations differ between developers, but it's common that you cannot resell until you've paid off a certain portion of the property yourself, usually between 30 and 45%. These rules are non-negotiable even if you do find a buyer. And once you make it past the minimum payment terms, you might run into several other problems. The first is if the developer still has unsold units. Selling your own will put you in direct competition with them, and you can bet a potential buyer won't buy your property when it's set at a higher price. Secondly, setting a high purchase price when selling during construction. If a buyer can find a completed apartment for a similar price to a half-finished one, why would they pay your price? And the third is that mortgages are almost exclusively for ready properties. Selling during construction cuts out all mortgage buyers, losing a significant portion of potential clients. So how do we avoid all this? You have to invest in properties that sell out quickly. They should be very unique, in extremely high demand, and you need to be able to meet the minimum payment terms. It's high risk and it's only possible with a growing market. But there are success stories. Take a look at Bay Grove Villas by Nahil. From the start, you can say that this project would likely flip successfully because the initial demand far exceeded supply. Many investors failed to secure unit despite being ready to pay millions for a villa. From April 2024 to February 2025, the average investor who resold their property achieved a 13% higher price, and some got a 23 or 25% upside. So look out for units in great locations with limited supply. If there are several thousand apartments or villas under construction, you have no leverage. A developer with low number of units that are likely to sell out, creating a high demand and increasing your property value. A rising market. If the market is skyrocketing, this strategy is much more likely to work in your favor. But if some world leader is starting a global trade war and Ray Dalio is predicting something worse than a recession, I wouldn't do it. But hundreds of hours spent searching for the perfect type of property would mean nothing if you make just one mistake. And to avoid this and dozens of other mistakes, reach out to my team. We'll help you select the right property based on your investment goals, analyze every aspect of it, secure the unit, and support you throughout the whole process. We handle everything end-to-end, completely free of charge. So call or WhatsApp us, scan the QR code, or click the link in the description to get a free consultation with my team. So the next step is assessing execution risks. It's easy to choose the wrong developer, and developers can be broken into 4 categories. The first are market titans. They're really established in Dubai, having delivered up to hundreds of projects. They're consistent in reputation, quality, and construction timelines. Their downside is their flexibility. They may require strict payment plans like 75-25 or 80-20, meaning you pay a huge portion during construction. You can expect this from developers like Imar, Nahil, and Miraz. Second, challengers. And they are not as huge as market titans, but are actively growing and successfully competing with them. Sometimes their buildings are even better quality and they often have more flexible payment plans, like 60-40 or even 50-50. Ellington, Shoba, Bengati, and Imtiaz are all in this category. The third type are selling not that good properties. These units are usually lack liquidity and are difficult to resell. It's hard to spot these developers if you're outside the market, but a good broker will know them. The fourth type is the newcomers. These are the developers who are new to the Dubai market or haven't been there for long. They're likely to offer more affordable prices and provide you with greater flexibility. Something to keep in mind is that a new developer does not equal a bad developer. They might even be better to work with, as they occasionally sell cheaper than well-known developers. So how can you make sure they're a good one? There is a system to reveal these hidden gems. Step 1. Look into their past work, but focus only on completed projects. If they say they've already delivered properties in other countries, that's a solid starting point. But careful, make sure you're double-checking the facts. Are those overseas developments legitimate? Can you find recent verifiable reviews from actual buyers or tenants? Next, take a look at who's doing the construction works. Some developers come from a construction background themselves, so you can often trace the quality of their past work. But here's a tip. The term contractor can mean just about anything. Even a company hired to clean up the site might be considered a contractor. Make sure you're looking at firms that handled major parts of the actual construction. Finally, research the leadership team. A developer backed by former top managers from other big developers is usually a safer bet. These are the people who've been around the industry, have real experience, and aren't likely to risk their reputation by overpromising or under-delivering. Once you've made sure your developer is reputable, you need to be on the lookout for delays. The thing is, any developer, no matter how good they are, can encounter delays for a number of reasons. If a developer claims they've never had delays, then it's likely they haven't been on the market for long. If they are rare and short-term, it won't be a major problem. But even if you found a great developer, you can make an awful investment if you select the wrong unit. So let's discuss how to do it right. At this stage, your goal is to choose the most unique unit possible to ensure it's in high demand by the market. Here's a non-exhaustive list of things to look out for. Great views, especially waterfront views and iconic landmark views. This often adds around 20% to rental price. Balanced indoor and terrace area size. This is especially important for small apartments. Spacious built-in wardrobes and walk-in closets in prime units. Spacious kitchens and closed kitchens. Having a closed kitchen is important for some nationalities. For villas and townhouses, another big factor is proximity to amenities. Being near but not directly backing into the pool, parks or shops is a major resale advantage. Vastu and Feng Shui compliance. Many of the real estate buyers in Dubai come from India and China, and this is a big deal for them. South-facing terrace, north-facing entrance, position of kitchen and bathrooms matter a lot. But all that was a qualitative analysis. Now let's run the numbers. I want to make this practical and take a real project. Say we're looking for a one-bedroom and are considering a one-bedroom apartment in Cove Grant by Imtiaz. Cove Grant is a 21-story residential building currently under development and with an estimated handover date of August 2027. One beds are priced at around 1 million dirhams or $270,000. The building is quite standard for Dubai with amenities such as a gym, a pool and kids play areas. But all the apartments are coming fully furnished and fully designed. But how will we measure the investment attractiveness of this property? Firstly, we'll look at cash-on-cash return. This is a simple way to assess the percentage paid back by rent. Basically, it refers to the cash you make against the amount you invested in the property. The higher the number, the safer the investment. Even if your unit doesn't appreciate over time, you will still make money from rent as long as you own the property. Secondly, we look at ROI or return on investment. ROI combines cash flow and property value appreciation and uses that to assess the overall profitability of the investment. So, you've found your unit. Now it's time to calculate your property acquisition costs. This term means the size of investment you're about to make. And keep in mind that this number varies for off-plan and secondary properties. Let's calculate for an off-plan property using the example of Cove Grant. Here the biggest cost driver is price. Then we take into account the 4% Dubai Land Department fee and small administrative fees paid to the developer. This usually comes to around 1.5 thousand US dollars. So to buy a one-bedroom apartment, it totals at 282,000 US dollars. For secondary units, you also pay the selling price and the 4% DLT fee. But because the developer isn't a part of the transaction, there are no admin fees. However, there are trustee services, which come to around 1.5 thousand. Legal advisor services to check the contract, which is roughly 3,000 US dollars. And agency fees, which comes to 2% of the original property price. It totals at 290,000 US dollars. If our project was already one, the total acquisition cost would be 290,000 US dollars. There are two really important things to take note of when it comes to agency fees. 2% for a ready property is the standard in the Dubai market. If someone is asking for more, it's time to find another agent. Brokers working in Dubai's primary market are paid standard agency fees by developers, meaning there are no agency commissions for buyers. So this means that a broker has no business asking you to pay commission. Let's return to prices. How do you know we're getting a good deal? For secondary properties, you can easily compare it to other similar units. Don't look at the listing price. Compare the asking price to the transaction price. Thankfully, you can always find the historical deals online, as Dubai has a transparent real estate market. Go to dxbinteract.com, click on Transactions, select an area or a project, enter the property parameters, including the type and the number of beds, click Search, and enjoy the detailed list below. When it comes to assessing the off-plan prices, it's important to use the right reference point. You'll need to look for a building in the same area, same or similar developer, and the same class of property. No good reference points in that neighborhood? Look at other areas. Think about how this development is priced in comparison to finished buildings on the market. Your next step is to spread the property acquisition costs over time and think about payment plans. Let's start with off-plan. Developers will offer structured payment plans like 50-50, 70-30 or 80-20, where part of the payment is made during construction and the rest after the handover. As I mentioned before, established developers often have stricter payment plans. Developers like Emmar usually have 80-20. This is because their buildings tend to sell out hours after the project is launched, meaning there is no need for them to offer flexible payment option. Remember that your payment plan, especially the frequency of payments and what they are tied to, will affect your investment case. Payments can either be tied to construction phases or to specific dates, or both. And if it's the construction phases, a developer might provide you with an estimated timeline so you can plan your cash flow ahead. But there is a catch. If the construction is delayed, you won't have to make up the next payment until it's completed. But if the construction moves faster than the developer told you, you'll have to make your payment sooner to match. So if you're locked into a payment plan, make sure you can access your finances quickly. And once the construction is complete, there are two payment scenarios. The first is paying all the outstanding balance in one lump sum. The second is entering into another payment schedule. It's common now to pay 30% over 20 or 30 months after construction is complete. One thing to note is that the benefit of flexibility does come with a price tag. Some post-handover payment plans increase the price per unit by up to 10%, which will lower your ROI. It's a good option if you plan to rent out the property and don't want to move money from another investment. You can use the rental payments to cover the needs of your payment plan. All of that being said, let's get back to our exemplary investment case. We're choosing between two real payment plans offered by Imtiaz: 50/50 and 70/30. Let's place the payments on a timeline. In the case of a 50/50 plan, your upfront investment will be almost $66,000 US. Then you'll pay $27,000 in 2025, $40,500 in 2026, and in 2027 you'll pay the outstanding amount of $148,500 US. For the 70/30 plan, your upfront payment will be almost $73,000 US. The difference is because of the higher price. In Cove Grant, the post-handover payment plan makes the price 10% higher, so in our case it's $297,000 US. During the construction period, you would pay around $30,000 in 2025 and $59,000 in 2026 and 2027. And after the construction is finished, your payments would be $29,700 for 3 years straight, because you would pay 1% of the total price every month. Finally, for this section, let's talk about the secondary market. The most important difference between this market and off-plan is that it's possible to get a mortgage. It's less common with foreign investors because the down payment will be 40% compared to the 20% offered to residents. Also, approval rates are lower, and even if they are approved, the interest rate will be significantly higher. These are just the costs related to acquiring a unit. Let's talk about the expenses that will come once it's occupied. We also call them operating expenses. When it comes to managing an apartment, there is one cost you can't avoid: service charges. This is what you pay to the developer to maintain the property. This will vary depending on the area, type of building, and the developer. However, you can expect to pay somewhere between $3 to $6 per square foot per year for apartments and about 3 times less for villas. The bad news is that these aren't small fees. A normal one-bedroom apartment can easily have $3,000 or $4,000 US per year in service charges. You'll also need to pay housing fees to the Dubai municipality if the apartment has not been rented out. They're equivalent to 5% of the annual rental value of similar properties. However, if you do secure long-term tenants, they'll pay this. Plus, renting out the apartment long-term means you don't have any other operating expenses. The tenant is obliged to hand over the property in the same condition as it was at the start of the contract, and tenant will cover all utilities and maintenance costs. They'll even cover the realtor commission. In our case study, the plan is to rent it out, so we're only paying service charges. In Cove Grant, they're about $4 per square foot, and the whole apartment is 710 square feet. Therefore, the annual payment would be around $2,800 US. However, the handover is planned in August 2027, so roughly a quarter of the first year we pay the service charges. Now it's time to calculate revenue. We'll start with rental revenues, as this value stream is the easiest to predict. We need to determine the current rates by finding the comparable benchmarks. This is easy for secondary properties because you can compare them to similar units in the same building. However, it's a little trickier if it comes to off-land properties. First, we'll look at the same neighborhood. If that area isn't built yet, we'll try to find a similar one. If the most similar one is already developed, we need to take away from its overall value. This is because the new area needs time to appreciate in value. Next, we look at the building. We need to find the most similar one. Ideally, the same developer and the same class. For example, you shouldn't compare Ellington to Azizi, or Address by MR, which is a premium building, with a more simple MR residence. Often you'll be looking at the first project the developer is building in the area. So in that case, find the closest match by a similar developer. If there is still no good comparison, we can try to estimate the numbers relative to your chosen developer's performance in other areas. For example, if Bengati's units are usually rented out for 20% more than similar Samana's units in the same area, then we can apply the same ratio in our case. Third, look at the type of unit. Things to consider are the number of bedrooms, studio, 1 bedroom, 2 bedroom or more, square footage, floor, view, and furnished or not. Once you figure out the current rates, you may estimate growth. Rent increases yearly in Dubai, but it's your choice to take this into account or not. If you want to be on the safe side, then make a conservative assumption that the prices will not grow. But if you decided to factor in growth, then you need to base it on something. One possible approach is to take the historical growth rate and assume the future trend based on that. This is obviously tricky. The future trend can be different. Another way is setting the target number based on the rates of other properties and assuming the time period needed to achieve it. You also need to remember that Dubai has regulations to protect its tenants when it comes to rent increases. The government body called RERA, Real Estate Regulatory Agency, calculates the smart rental index for each building. Here are their conditions. If the current rate is less than 10% below the market value, no increase is allowed. If the rent is 11 to 20% below the market value, a maximum increase of 5% is allowed. If the rent is 21 to 30% below the market value, a maximum increase of 10% is allowed, and so on, with a maximum possible increase of 20%. And if there is a market average growth that allows for a rent increase, the owner must give a 90 days notice, and if you don't, you'll have to wait another year. They also have strict rules about evicting tenants, so you can't just kick out the current one and find another. There are only 4 reasons you'll be allowed to evict a tenant. First, personal use. This is if the landlord or their immediate family intends to occupy the property. The landlord must provide a proof of this intention and give a 12 months notice. Second, sale of the property. In this case, the landlord also must notify the tenant with 12 months notice. Third, significant renovations or redevelopment. If the property requires major renovations that make it uninhabitable, the landlord can refuse to renew the lease. This also requires a 12-month notice. Fourth, tenant's breach of contract. If the tenant violates the terms of the tenancy agreement, such as by not paying rent, the landlord may refuse renewal. So, it's not that simple. Now let's apply all these inputs to our project. We did our research and realized that now there are no comparable buildings in the area. Cove Grand is located in Dubai Land Residence Complex, and until recently no big developers were building there. So what we do is a relative estimation. There was a similar case in another area, Al Furjan. There, Imtiaz has built a project that has a much greater quality compared to any other ready one, so the rental rates were 40 to 60% higher than the area's average. We assume that the same will happen with Cove Grand in Dubai Land Residence Complex. There, an average one bed is rented for $14.5 thousand US dollars. A 40% higher rate is $20.3 thousand US dollars. And if we compare it to other areas of the same class, it doesn't seem overrated. One bed in Westwood by Imtiaz and Al Furjan is rented for $27,000 US dollars. And Westwood Grand in GVC is also the same rate, $27,000. So it's $20.3 thousand, and we want to be on the safe side, so we assume no rental rates increase over years. So here's our rental returns on the time scale. We would not make any rental income until 2027 because the building would be under construction. And as the handover is in August, we should start making money sometime around October. This would be $5,000 in 2027 and $20.3 thousand per year going forward. What you should note is that such rental revenue won't be enough to cover the service charges and post-handover payments. However, it's a conservative scenario, and even in this case, it covers roughly 2/3 of the expenses. Now, as this project is a 100% residential area, it isn't suitable for a short-term rent. So for the purpose of this study, we won't look into the fees associated with Airbnb. So you've assessed your operating costs. Now let's look at how our unit will appreciate over time. It's impossible to know for sure what the growth rates will be over the next years. So what we need to do is create conservative, realistic, and optimistic growth scenarios and project the growth based on those. Keep in mind that we can't account for crises, wars, pandemics, crazy tariffs, and other macro shocks, because these are always unpredictable. We need to start with the market forecast, meaning how we think the prices will act on average. Here are some data points to consider. First, the average 10-year apartment price growth in Dubai real estate is 3.5%. As this period contains different economic phases and includes the COVID crisis, this number can be used in a negative scenario. Second, there are always some comparable ready properties. and it's fair to assume that the off-plan unit will reach the price level of the ready one when completed. This approach can be used in a realistic scenario. Third, these comparable ready properties will also grow while the off-plan property is under construction, so at handover the new unit will reach the price of other ready properties after the increase. This is an optimistic scenario. Normally we do all three, but for our case study let's go with a negative scenario. Now we apply the 3.5% market growth, and in 5 years from now the property price will reach $331,000. That's a 22.5% increase from now. Using this approach, don't fall into the trap of overpriced properties. In our case, the post-handover payment plan increases the price by 10%, so the value appreciation should be modeled based on the lower price. Now let's put everything together and calculate the key investment metrics for both payment plans. First, 50-50 plan. According to our case modeling, the total spent in 5 years would be $291.5 thousand US. Rent would generate $61,000 US, and selling the apartment would bring us an additional $331,000 US. What does this mean? We divide rental revenue by total spend and get cash-on-cash returns of 21%. This metric shows what share of the invested amount can be paid back by rental returns. This is a solid result, given that we were quite conservative on our estimation. This also takes into account that the building was under construction for 2.5 out of those 5 years. For ROI, we divide the sum of the asset value price and rental returns by the total spend. This gives us 34%. Let's quickly take a look at the same metrics for the 70-30 plan. Here the numbers are a little lower. Cash-on-cash returns are 19%. And ROI is 23%. The difference comes from the higher apartment price because of the more flexible payment plan. Overall, these numbers aren't bad, especially because it's quite a conservative scenario. And we do this kind of assessment for every investment opportunity our clients are serious about. If you're ready for our help, just drop us a message. If you're still exploring, invest your time in learning more about the best areas to invest in. This video will help you. Check it out.